now. Good morning, everybody, and welcome to CICM Best Practice 11s of July. We've still got people joining, so I'm going to keep letting people in as we're going. Thanks very much indeed for joining us. We have Dan Hancocks today from CoCredo. Thanks very much indeed for joining us, Dan. A pleasure as always. And Dan's got some interesting insights into what's going on in the marketplace at the moment from a credit reference agency point of view and a credit management point of view. We've got some polls today as well. And we're going to start off with a poll on this session as well. First, just to sort of get people thinking about credit reference agencies, credit risk, etc. So I'm just going to run the first poll now. What we're going to do is I'll capture the responses to the poll, and we'll have a discussion towards the end of the session as well about this stuff too. So let me just go in and launch the first poll. So these are sort of general questions around credit risk management, the industry itself, etc. So we're just launching the poll now. You should be able to see that on your screen. So the questions are: what do you think of the current credit risk in the market or industry that you're in?
I couldn't hear
what is your that's Siri kicking off? Sorry about that. I'll have to turn that off. Typical, isn't it? So what is the current risk at the moment? What is your organization's credit risk compared to pre-pandemic? You know, what's the appetite for it? Do you expect to use credit reference agencies more in the coming months? How many credit reference agencies do you use currently? None, 1, 2, 3, more? And do you use Champion Challenger with your service providers? So those are the questions. If you could just respond to those, that'd be great. And when we get up to sort of 80% or thereabouts, I will end the poll. So what do you think of the current credit risk in the market? What's your credit risk appetite compared to pre-pandemic? Do you expect to use credit reference agencies more? How many agencies do you use? And do you use Champion Challenger? Okay. So we've got 55% of people have responded so far. 65, 67, coming in fast now. 33 of the 49 people. 35, 36, here we go. Okay, up to 77%. A few more of you to vote. Here we are, 83. We're going to do a couple more of these as well. So this is the first poll of today. So we've got 87% have voted, 43 of the 49 have voted. I haven't, so I'm one of them. So I will end the poll now, and then we'll just have a very brief look at the results. So I'm going to share the results with you all now, so you should be able to see that. So higher risk. So do you think that the current risk in the marketplace is higher? And the general view is yes, it's higher. So 74% said higher, lower 2%. And pretty conclusive, and about the same 23%. So that's interesting. So our appetite for risk is higher now, 28%. That's interesting. Our appetite is lower, 16%, and it's about the same, 56%. That's interesting. Okay, then do you expect to use credit reference agencies more? Yes, more. No change. It's about the same, 49 and 51%, 49 and 51%. Nobody is going to use them less. So that's good news for you, Dan. How many credit reference agencies do you use currently? None, 9%. 44% use one. And these questions are quite relevant, actually. This particular question is anyway. You use two, you've got 30%. 3, 9% or more. 7% of you use more than 3 credit reference agencies. Wow, that's surprising. Okay, so do you use Champion Challenger with your service vendors? 56% have no idea what that is. 14% yes, we do. No, we don't is 28%. Not all the time, 0%, and not only at renewal, 2%. So Champion Challenger is when you pit one credit reference agency or vendor off against another to see what their performance is like. And then you pick up, if whoever is better, you then take that one, and then you do Champion Challenger again, bring in another one and test them as well. That's what Champion Challenger is. And it's something that I use a lot when I'm working with clients. And I always recommend that organizations do. Keeps your existing vendors hungry for a start, and also stops them from getting complacent. So I'm going to stop sharing that. We've got other polls going through. So we'll come back to that later on. So thanks very much indeed for that. I'm just going to let in somebody else coming in. Okay, so so once again, I'll introduce Dan. He's got a presentation to take us through. He's going to be stopping sharing and then resharing, and then we're going to do a poll, and it's going to be quite complicated. We're going to see if it works or not. We've tried it before once, and it kind of worked. Yeah, no pressure, Dan. We kind of worked, so we should be okay. So over to you, Dan. I'll leave it up to you. So you can share your screen now.
Let's hope it gets the right screen. There you go.
Thumbs up if you can all see that. Great.
Let me track that there. Well, smashing. So how does this work then, Chris?
You just page through it.
The screen and then see me, or can they just see the screen now?
Now they can see the screen and you in the same way that we can with four tiles down the side.
Okay.
Yeah.
Well, good morning, everybody. Thank you so much for all joining us today, especially when a few of us certainly may have a little bit of a sore head after last night. So what Chris and I wanted to do today was try and have an interactive session. Whenever I see that type of thing come through, I normally think to myself, oh, do you know what? I'm going to get asked awkward questions and that sort of thing. So do I really want to get involved in this? Equally, I don't necessarily want to sit through a presentation whereby it's just multiple slides over and over and over again and listen to one person's monotone voice. So what I want to try and do is try and do the opposite to that and try and get it to interact a little bit with you. There's a little bit of a game in the middle. There's no way in which to test, obviously, and I think that everybody will be kept unanimous as well. So when Chris can't see who is voting what to the little game later, but hopefully that's a little bit of fun as well. So what I wanted to do on this presentation today is talk a little bit about post-pandemic and risk and credit reference agency information. One of the reasons why I think potentially an individual who can talk about that is for those that don't know you or don't know me, sorry, if I click him through to that and don't know CoCredo. CoCredo have been around now for 19 years, coming up to our 20th year. What we try and do as a credit reference agency is try and be a little bit different, I suppose, in two aspects. And one of those is something that I'm very passionate about for those that know me, which is great customer service, treating people how you'd want to be treated. I think that there are a number of companies out there, not only in the credit reference agency industry, but everywhere in any sort of walk of life that quote the fact that they offer a great customer service. I would certainly hope that we do and stand high in that. So in order to have great customer service, you have to have good dialogue with your customers and suppliers, lenders, etc., etc. So I think that we're very proud that that's one of our points that we're very, very good at. Secondly, and where this sort of falls into place, is that we aggregate data from multiple sources across the world, actually. So a lot of the agencies out there at the minute do that, but do it through a multitude of owning their own offices and then also working with third-party suppliers. And we do the latter. So we're constantly blind testing the data, and we do that on a future perfect thinking basis. So we look to see what has happened to a particular business, not only in the UK, but abroad. And then we work our way back to see what data is available out there and that would have predicted that sooner. So then we can pass that on to our customers. And what they can do is then come to one portal and hopefully gain the access to multitude of different data sources all in one place. So I think, whilst Chris asked me to do this presentation, I'm certainly not going to have all the answers, but what I've tried to do is through my research and through sort of interacting with you guys, then hopefully we can try and come up with a plan together. So I certainly don't know the holy grail of what's going to happen. I'm certainly not able to predict the future any more than anyone else is, but I've tried to bring that all together today. I think the third bit which is important as well for today's presentation, is that I'm also a business owner. I own CoCredo. So I look at this from a perspective as you do, in the fact that we're either running our own businesses or working for a business whereby, cash flow is key, speaking to our customers is key, etc., etc. So we're all sort of going through a similar sort of situation, so that we can all talk about this together. So what I wanted to do first of all was set the scene. I'm going to fly through some slides. So, you know, please by all means ask any questions on the chat and anything like that. So just to set the scene, to give you an idea of where the sort of private sector is at the minute, and this is taking the data that's come last out in the public domain. We haven't yet got data for 21, but I am going to give you some figures that I've got. There's about 6 million companies in the UK. I would say at any one time you're looking at about 2 million that are actively trading at any one time. The thing for me that's quite stand out from that basis is the fact that, you know, there's 99% of companies file very small accounts, micro accounts or no accounts. So it's very difficult for a credit reference agency to really use that information in any mass with that and that alone. So we're moving to a situation whereby that is becoming less and less. And interestingly, the 1.4 million of those actually have employees, and the larger proportion, 76, only are manager-owned business. So, and I think that with the pandemic, we may have seen a situation whereby that is certainly even increasing into some respects. And there's some reasons why that is, and I'll be interested to hear your feedback. When we're looking at how that's grown in the last year that we can look at, it's grown about 2%. So the number of companies, it tends to be on a keel moving upwards in terms of the fact that we're getting more companies set up every year. But interestingly, only about 3,000 of those actually employed people. So again, the huge majority of that were non-employed businesses, whereby they've either been set up as a dormant business or they're a one-man band from that respect. Now, we may have, when we were coming into this pandemic, probably in sort of March last year, we were certainly seeing that was there the optimism of what's going forward. We didn't certainly know what was going to happen as well. So were there a lot of new start companies? Were there companies expanding other than that were potentially were maybe in certain industries? So we've certainly seen a dip, if you like, in the number of companies that were being started, and also in terms of, I suppose, new lines of revenue and that sort of thing. So other companies going, okay, I'm going to diversify into this market or whatever it may be. So we saw a dip, and I'm going to show you those figures in a minute. But what we've also seen is probably June time last year, a phenomenal, and that's the word that the Companies House have chosen to use, a phenomenal rise in business startups. So there's probably a number of reasons that we can look at why that is. And what do we know about these businesses? They're new start businesses. So, do we particularly know a lot about them? But yet we as a business are trying to decide whether they are high, medium or low risk, whether we extend terms to them, what we do, etc., in a market whereby we want to try and still bring in the sales, and sales are important to drive that business. So these figures I received early this week. So this is directly right up to last week. To the end of June. And if we look at the grey line here, we can see that in terms of the number of startups that were made at Companies House, we saw that dip, which we were expecting sort of right at the beginning of the pandemic. And then what we're then finding is that in June last year, if we were to look at June last year, there were actually 75,000 companies incorporated in 1 month. Massively, other than March in this year, certainly that's unprecedented in any month were to have 75,000. We then beat that again in July last year, where there were nearly 80,000. So there was a huge number of new start companies in a time whereby we were right in the crux of that pandemic. And that realistically has maintained December. And then it's then gone and maintained that. Am I still?
Yeah, you're still on, yeah.
Sorry. It's then maintained that throughout the course of 2021, the yellow line here. We've then had pretty much, it still didn't beat. So there was, in March this year, there were 78,000 companies started that month, compared with 80,000 in July last year, but it's pretty much up there. So when we look at where that is. We're now down to, in June last year, 49,412 companies were formed. So just under 50,000 companies were formed last month. So when we're speaking to Companies House and we're speaking to some of the formation agents to try and find out why that is, there was 3 standout reasons for that. So their response is, it's Phoenix companies. I'll put the definition here for those that don't know. So a Phoenix company describes a business that has been purchased out of a formal insolvency process, such as administration or liquidation, often by the existing directors. The term refers to a Phoenix rising from the ashes, but there are strict rules that govern the use of that process. So there is a huge amount of that going on. I think to a certain extent where we can look at is probably the next one, when we're looking at the figures that we just saw, whereby there was 77,000 companies started in March last year. The reason for that was because the B bills and the C bills came to an end. So already there is a huge level of feedback coming back from the industry that there has been a huge amount of fraud, because companies are being purely set up as a model to get a loan, and that is in itself really worrying, because of the fact that we've got 80 million pounds that has been sent out on loans. I'll show you the figures in a second to the actual figures, but equally they believe that 27 million of that already is fraud. So there's a huge amount of money that's been lent out. Equally, potentially the taxpayer is going to pay, but a lot of these new start companies are being set up as mechanisms for C bills and B bills. So that's a bit of a worrying basis, and we can see why the figures have gone back. One of the positives that I think has come out of this is that you may look at it as a positive, double-edged sword to a certain extent, is that a number of people will have been made redundant. They will have been made redundant over the course of the pandemic for whatever reason, and in some respects will have been given a bunch of money. So what has then happened is that individuals have said, well, I've got some money now and I've got the time to go and do this idea that I've always wanted to do. And in my opinion, fair play to them, that they've actually then gone, okay, do you know what? I'm going to start this company up. I'm going to drive forward, and I'm going to use that money to do so, that entrepreneurial spirit. I think that whether that continues, that's something, again, to be wary of, guys, because of the fact that if that business doesn't pursue the way that they anticipate it will do, then that's going to potentially leave, bad debts there and potentially companies closing. Also, if they get a better offer to go as industry changes, to go back to an employed job, maybe they've been finding it hard. There's going to be a lot of movement there, we predict, from that basis as well. So that's the main 3 reasons why you've seen such a huge increase in new start companies. So when we then look back to the 6 million that we had in the private sector at the end of 2020, we anticipate the fact that's going to be a lot bigger throughout the course of the next statistics. And this gives you an idea broken down. So I said 80 million. There's 80 million pounds been lent out in emergency loans. It's been split mainly between these 3. So when it says 21st of March on here, these figures here are from HM Treasury. These are on the last basis because it finished on the 31st of March. These are the sort of numbers that we're looking at in terms of where they're split, just to give you an idea. As I said before, 80 million pounds has been loaned out. We've got 1.67 million loans. So when we look back and we anticipate the fact that there's probably 2.2 million actively trading companies, that's a huge number that have been lent money. If they are actively trading correctly, or are they, as we've looked at before, and as we've had back from some industry experts, that they're quite highly likely going to be fraud. So it's something to be really, really wary of. What I wanted, which, if I'm really honest with you guys, I wasn't really aware of this before I did my research over the last week, but there are still quite a significant number of supports being available to business. So we all see in the news, and maybe we're affected by it in our business, that furlough is still to an extent available. The recovery loan scheme is still going until the end of the year. We've still got business rates and VAT relief, although the business rates has gone from 100% to 66%. So that may have an effect, certainly for the retail, hospitality sector and leisure. They may find now that they're now having to pay those rates. Is that going to have a weighting on their struggle and their challenge going forward? And also the temporary prohibition of commercial evictions. So that's still in case as well. We've also got the introduction of the pay-as-you-go scheme, which gives you a 6 months interest basis, and then you can then apply for up to six or 10 years to repay those loans back. So it's not the fact that we're necessarily going to see that all the loans need to be paid back immediately, and then it's going to put a huge amount of companies under pressure. There's schemes in place in terms to try and eradicate that over time. So I think we need to be aware of that there is that longevity in place. From doing my research a little bit, I'm not going to name names, but there are some schemes that apparently are launching in July as well, so coming from the government. So equally, if anybody wants to share their knowledge of those at the end and share those with the group, then I'm sure that we would all benefit from that. So is it all doom and gloom out there? Well, I don't necessarily. I'm trying to be quite a positive person anyway. Look on the brighter side of life. And 30%, 40%, 39% of SMEs from the figures that have come back from actually a survey that Metro Bank put together are saying the fact that 39% of companies have seen an increase in revenue even from the 17th of May. So, we're really getting a kickstart. There's a number of a huge amount of money being put in savings from the figures that we've heard back. We've only seen that half of that has seen a drop, which actually was probably higher than I expected, if I'm honest. And the rest of the remaining percentage see no difference. So I just wanted to mention something that Joe McDonald, one of the directors at Metro Bank, has quoted, just to share that with you as well. So the latest polling shows us that a significant number of countries, small businesses are still struggling from the effects of the pandemic. Many of them require patience and tailored financial support in order to keep trading in the current environment. We should never underestimate the value of human relationships in banking. People value other people, and as businesses in the UK recover after what's been a really tough period, that's arguably the most important now, more important now than ever before. Something I always go back to, I said right at the beginning of this, it's all about having dialogue with your customers. It's all about, and your suppliers and your competitors and your lenders and that sort of thing. And she certainly echoes that as well. So if we look.
He'll come back in a second. Am
I back?
Yeah, you're back.
Sorry.
That's okay.
Sorry.
If you close down a couple of other open windows, usually helps.
What the outside window?
No, the window on your laptop.
Oh, I'm playing with you. I'm joking.
Thank God for that.
So 49% of SME owners or directors hope to keep businesses on an even keel this year. So I think stabilisation is something that, as a business owner as well, certainly something that we focused on CoCredo last year, was stabilising the business, moving everybody to home, making sure that everybody's safe and sound, and that we can still service and work with our customers in business as usual basis going forward. So I think a number of companies are still seeing 21 to be very much like that, with all the vaccines coming through and everything like that, and certainly the messages coming back from the government. Interestingly, 40% are planning growth, which is great, and only 1% considering closing their business in 2021. Now, when we look at the same poll that was done last year, it contrasts dramatically with the fact that 46% of that survey actually confessed that they were considering closing the business down last year. So that's gone from 46% thinking, do you know what, I don't know whether I can carry on. I mean, arguably, maybe 45% of those did close the business, and that's why there's only 1% left. I don't know, but equally, I doubt it. It's interesting to see that there seems to be a lot more optimism in the market. I would certainly hope so. I think what's something that's come out of this pandemic as well, is we try to look for the positives, are that there's been some improvements to people's business, and that not alone is, speaking to customers, again, the dialogue with customers and understanding what pressures they're under, and putting payment plans together and seeing what their aspirations are going forward, what their challenges are. I think that certainly we've seen it from some of our customers, is that they're certainly looking to be a lot more agile. They're looking at new revenue streams, and that has come back from surveys of all the companies that were surveyed on that. So that's interesting to know, in the fact that there are some positives that are coming out of this, and certainly I think we should look at those. So from the research I did, I actually got some information from the World Economic Forum. I'm not going to sit here and make out like it's all coming straight off the cuff from me, but I was quite interested in reading the articles there, and they split it into 3 things going forward, in the fact that the real things to focus on going forward from a credit risk point of view are to look at political risk. So when we're looking at things like that, we're looking at, are there going to be government emergency plans? Are they going to all of a sudden say that we've got to have restrictions, and therefore that has effect? Are we going to go to a basis that we're going to work on a geographical lockdown basis, which may well have effect? So there is still a huge amount of risk. We don't know whether the winter is going to bring some change as well, that is going to be driven from political basis. So are we going to find that that's going to have an effect? I think also as well, something that fits within that is the basis of Brexit, and also what we're seeing from a supply chain point of view as well. So is that being affected partly under that political basis? I think so. So one of the things I heard, I'm waiting for some garden furniture to be delivered, and it's now about 4 or 5 weeks overdue in terms of when it was supposed to be coming through. And one of the things that they said is that it came, I believe this from the figures they've given, is that it came into a port, I think it was either Portsmouth or Southampton, and it was told to go away again because of the amount of duty that was paid on it had actually increased while it had been in transit. So then it was then sent back to Rotterdam, which is where it is now, and then it's now on a lorry coming back into the country via a different way. So it's probably going to be 6 weeks more. So does that have an effect on your supply chain? I think it does. I think in terms of where it certainly seems to be so, and that's driven, if you ask me, from a political basis.
Yeah.
Technology-wise, one of the things that I think we're all, even sat here today, we're adopting is how the movement in technology has been driven forward. But I think from a risk basis as well, we've got to bear in mind that there is going to be a lot more fraud, and there is a lot more means, because we're communicating via that basis, for whatever basis. We're finding the fact that there is a lot more risk from a technology side of it, and with that comes cost as well that we need to put in place in order to be able to exercise against that. Interestingly, the third one, which the World Economic Forum found from a risk point of view, was what it says here at the bottom: social. And I think that was a surprise to me before I read it, or whilst I read it, but then afterwards it seems to make a lot of sense, which is really coming from a basis that a lot of people now are aware when they're buying things of how a company is treating its employees, whether it's environmentally friendly, how it acts, because of the fact that there is potentially always another company they can use that is much more on their social relation, on their social platform, if you like, where they can actually get a much better relationship and buying basis with them. So from a social basis, we're looking at things that they're socially enamored with, but also as well, I think that something that we need to be aware of is mental health, and how people are feeling from working from home, because most of us are now as well. So although there may be a basis where people are coming back, so I think that that's probably not, sometimes it's maybe overlooked. Certainly I was interested to see that the World Economic Forum didn't think so. So they're the top 3 risks that they felt. Equally, I think, going back to some of the things to focus on from a business side of it, obviously digitalization, we've said that. I think cash flow is more so than ever really, really important, because of the fact that it drives a business. And I think certainly the feedback I've heard from a number of people, many of you on this call today, is that, that I think that the expectation was worse than the reality with cash flow, and people have been, the aged debtors have been working quite closely with you to try and recover that debt. So I've certainly heard really positive stories. I'm sure there are bad ones as well. As I mentioned before, another key area to focus on from a supply chain point of view is to be aware of the fact that there might be border challenges, and there may be rising costs and that sort of thing. So staffing, One of the things that we've had recently is that we've had one of our account managers moved to pastures new, and one of the reasons, I'm sure he wouldn't mind me saying it even if he was listening to this call, is one of the reasons that I think that he left was because of the fact that he'd been stuck in his mum and dad's bedroom for a year and a half, and wanted a challenge and wanted motivation, of which we found quite hard to give him. He a lovely gentleman. I'm sure that we'll still remain friends going forward, and I really wish him well. I understand the fact that that he wanted a new challenge, so that mindset quite interests me, in the fact that he wanted a new challenge. He wanted to get out of the situation that he was in, from, I suppose, because also his new job was in the office, whereas we aren't going back to the office at this minute. So he felt that he needed that for his mental health, and I think that's worth being aware of it. But also, I from the other side of it, as an employer trying to bring people in, we had job adverts out there. We had recruitment consultants trying to find us people, and this time, more than any of my employing people at CoCredo, was the least amount of people available on the market, and good people. So I was really surprised. But the reason I had as feedback to that are that there's the loyalty from people, that if you've been looked after during the pandemic, then we want to stay with you. And also, if they do move to somewhere else, last in, first out. So I think that staffing, from a point of view of change, and also from a point of view of looking after the mental health of your staff, is really important, and something that definitely every business needs to focus on. And equally with that, you've then got your work-life balance. So I think that we've got to respect the fact that people need also to have time away from work in order to. Someone said to me recently that in order to be able to pour a jug of water, you need to have water in it. And I think that if you don't fill your jug full of fun things to do and allow people to have their time away from work, then they won't be able to pour that jug as well as they would if there's nothing in it, because it's just full of work. So I think that that's really important going forward. So when we now focus on the credit risk side of it, if that's okay, appreciate the time, we're going to go to our little game now. What I want to do is I wanted to try and play a game whereby we could try and use your expertise to try and look to see whether you can predict what a credit report is going to say. So one of the things that I mentioned right at the beginning of this is that we do blind testing with a number of different providers. So we look at their data without looking at the brand, and we look to see certain companies that we know that what's happened, and whereby we'll work our way back. So, and a lot of the credit reference agencies do that. A lot of the credit reference agencies also are really not struggling at the minute, but they're having to change their ways, because they're having to get data in from different sources and learn from history and everything like that in order to try and put a really predictive scorecard together. And that's with less data that's available in the market. I think there needs to be a little bit of a change in the market whereby, and I've said this for a long time, that we need to start adopting a larger company mentality so that we're filing more if we want to be given more credit. I'm hoping that may, over the next 3-4 years, certainly become more, rather than just filing as little as you can get away with, which is probably the way that majority of companies work. Nothing necessarily wrong against that. And I think that a lot of the credit reference agencies, certainly two that I work with, have really focused on updating their scorecards and taking into consideration, where we are and what data is available to them. To give you a little idea of the recipe, this is something, again, that I've used before. In no apparent order, these are some of the things that, if you look at a scorecard from a credit reference agency, primarily these are the things that a lot of the reference agencies will look at. So one of the things I've done in terms of my research is that, and I'll say this with a smile on my face, is that I've been monitoring all the partners that we work with. And I say partners because of the fact that we work with most of the credit reference agencies out there. We work with a lot that are directly, I suppose, competing with us in the market. but also as well, friendly wise, but also are supplying us data and that we're working with on a friendly basis to make our product better. And I think that there is a level of respect and honour that we have between all of them in the fact that we look at. One company that we don't work with, I read a presentation that they did last week actually, and they were talking about structured and unstructured data. Structured being, you know, the data that I've just shown in that last recipe basis, and then they were talking about unstructured data as well. Making a structure to unstructured data. How can we use that? And I think that we're all fully aware of the fact that there is so much information out there and a lot of it false. One of the things that we need to be able to do is try and work out how we can validate that. Now, nothing I have seen, and I'm not to say that I might be wrong, but, and I'd love to be proven wrong, because actually that'd be a really good thing. But everything that I have seen up to now has been the case that has not been certainly included in any scorecards. So if you're saying that, oh, well, we're looking at social media data and actually we're incorporating that as part of our scorecard, correct me if I'm wrong, if anybody knows any differently, but I certainly haven't seen any method of that. I think there is, certainly from the individual that I heard say it, said that it was already been included in their scorecard. Well, excuse me, I'm pretty sure there's ladies on the call, but that's a complete load of rubbish. So as far as I'm aware. So I think it sounds great that we want to be including that type of information in the scorecards. I haven't seen any basis of that as of yet. So something that I think is really important to do is maybe have access to that data, certainly in the credit reports and complementary products, so that you as experienced credit controllers and finance individuals, you know, you can say, okay, well, actually, we've got a credit score from a company here. We're aware that it's taken a lot of the structured data into incorporate a scorecard, but actually we've also found this and this here that also affect my decision in whether we work with that business or how much credit we give them. And certainly, you know, I know that there's one of my customers on the call here who does this. I won't embarrass him by saying it out there, but I know puts a lot of other aspects into a scorecard whereby, you know, not only are you just taking a scorecard from a credit reference agency, but you're also putting a load of other things involved in that, whether we've worked with a company before, whether they've got any age debt over 91 days, you know, whether they're in a country which we think that are particularly high risk, whether we think they're in an industry that we think are high risk, forgetting whether a credit reference agency think they are or not, you know. And that's something that I think is the way that things should be going. Is there any government support available to that company? All things that are going into a much larger decision basis. So where I would see a credit reference agency, and speaking from my point of view as well as a business owner, I think they're a string to your bow. I think we're a string to your bow. We're not the complete and holy grail. And we're going to see that because I think as well, something that, like I said, we've done from the outset is that you have to use that information that you've got in a CRA along with, you know, knowing your customers and having a dialogue with them. So the technical bit. What Chris is going to do, if this all works perfectly or close to it, is that I'm going to give you some information in the credit report. I've taken out all of the credit decision, if you like. So I'm going to scroll down the report. They're 3 companies I've picked at random. And I'm then going to show you what 4 credit reference agencies have shown on that particular industry, on that company.
Yeah, that's after we've done a vote.
Yeah. So we're going to ask you, when you've seen the information on company A, do you think it is low, medium, or maximum risk? You then vote, and then I'll show the answers, hopefully. So, drum roll. So the first company, I have been, me and Chris have done this once already, which is where the idea came from. You may be using other credit reference agencies. You may be all using one. I have no problem if you want to go and check this yourself because it's live data. Jason absolutely will be. I have no doubt of that, and I wouldn't expect it myself. But equally, it's all live data. It's all true to form. So please, by all means, be my guest. If you're using a different provider that then has another opinion on this, I think if anything, it's probably only just going to prove my point even more. So I am now going to try this. Hopefully, this works. Right. No one saw that. Right, is that still showing? Is this showing the report for
This is Sigmat. Yes, well, I can see that. Yep.
Okay. Right. So again, it's a bit of fun because I have done this with, you know, in real with people, and you can flip through a report and you can gain more information. So by all means, if I need to go back or anything else, I'll try my best to do it as we can online. So,
Okay.
Chris, you be my guide if you think that.
Okay. Yes. Carry on. Yeah. Go down a bit and hold it there for a minute. Hold it there for a second. Yeah. So that's the accounts and financials. So is this a high, medium, or low risk? We'll have the questionnaire in a second. So this is balance sheet information. Okay.
Am I right?
Assets 6. So go up a bit slightly. Go up to the assets piece. There we go. Okay. Go to the assets. This tangible and intangible stock. We got the overdraft stuff as well on there. Okay. Go to profit and loss. Okay. Hold it there. Hold it there. That's it. Turnover, exports, cost of sales, etc., etc. You've got the numbers and the arrows, which way they're going. Cash flow, come down a bit. There we go. Net cash flow from operations, and okay, hold that. Okay. And there's some stuff around payment experiences.
Yeah.
Total number of invoices available, how many experiences I've had, whether they're good, bad, or indifferent.
This is probably, sorry, on the page break there, but just to give you an idea of the days beyond terms that we've recorded.
Yeah. Okay. Okay. Right. So, so this is the first one. So, so if you want to sort of flick back up to the top again, Dan.
Just going to check there's nothing else. So there's some charges. Hang on.
Okay. Charges and mortgages.
Go
Auditor opinions.
through that really quick.
And that's all of the corporate stuff. Yeah.
That may affect the rating as well. So just show that really quickly. And then we just go through number of directors. You can see. Right, cool. So if we now go back to the top.
Go back up to the top, and have a just sort of have a look at that first bit, and then go down just slightly. There we are. As a financial summary. Hold it there. Right. Okay. So here we go. Let's see if this works. Right. Do you want to stop sharing there, Dan?
Right. Hang on. Right. We did practice this earlier.
We did. There we are. Okay. So I'm gonna we've got a poll coming up now. So poll the credit risk challenge. So I'm launching the poll now. Is this customer a low, medium, or high risk? Ignore the second question. I don't know why that one's there. Low, medium, or high risk for Sigmat?
Am I allowed to answer?
You can answer, Dan, because no one can see what you're answering. People are asking untitled question. Don't bother answering the untitled question because it's not there. It is the first three questions you got there. So it's low, medium, or high risk is what we're after.
You have to answer it. Here, Dan, they filed new accounts yesterday, mate.
They did, buddy. If you give me a second, I'm going to tell you that.
Okay. So we got up to 51%, 50%, 50, 59, 60. So we've got a medium risk. I think people are probably just sitting on the fence here. Are we sitting at medium risk? Medium risk. Okay, got 70% have voted. 70% have voted. And we are
the right answer. There is a worry here.
Okay, let's hold it there. Okay, so 74. Right, let's end that poll. I'll launch the results. And basically, we're looking at, generally speaking, a medium risk, which is 51% say medium risk, 37 say low risk, and high risk is 11%. Okay, so I'm going to stop sharing that now. Dan, you can share your screen again.
Okay, hang on.
And you can tell us what the answer is, allegedly.
Are we back?
Yep, you're back. So Sigmat, there it is. So explain that then, Dan.
Okay, so we've got 4 providers there. Okay, so just on the same day, so on the date that I've put there, this is what they're showing. So CL is credit limit and RI is risk index. So a risk index is on a score between 1 being poor and 100 being perfect for all of them. But quite interesting, and this is something that we do from time to time, and we're always looking at our providers. But where we had the recipe before, on one of the previous slides, we're showing the fact that there are a load of different things going into those scorecards, but equally, if I was only tasting one of those, let's say it's a cake that those ingredients were for, if I was only tasting one of those cakes, I'm only going to get one flavour. But actually, if I taste 2 cakes or more, when we go back to the poll that Chris did right at the beginning, sometimes it shows the fact that there is quite a difference between providers in terms of what they're doing there. So if we look at provider A, 189,000 and a score of 22 out of 100. Provider B, 1.1 million with an 81 out of 100. C's 510,000 with 100 out of 100. And D is 500 with a risk score, £500 with a risk score of 85. So really, really different. So if we look at some of the things behind this, okay, so provider A and D take into consideration parent information. So when Chris was saying about the report and we went to the structure at the end, but that has had a huge amount of weighting on the basis of whereby provider A and D, huge amount of information and focus on the parents. Provider D, the reason why that is really, really low is that provider D also puts higher weighting on filing full accounts based upon their scorecard. When we were looking at it, we were showing the fact that they were the age of accounts, and I think we're seeing this in a tip for the other two that we're going to look at as well. The age of accounts, because of the distance in when they were last filed, is not because they are late, it's because they are old. So is a company being downscored? And I would say that you can clearly see with provider C, no, because those accounts are later. Because are they due to be filed yet? What would a company file them early? Now, Jason said quite rightly, they've just filed in the last day. So when I put this together on Tuesday, we actually had notification that from Companies House that they'd filed. They haven't been interpreted, unless Jay's can tell me different this morning. I haven't checked this morning. They haven't been interpreted, which normally takes about 3 days, by the credit reference agencies in order to take those new accounts into place. Now, by the basis of the fact that they will be new accounts, you could argue the fact that actually they won't be losing score because of the fact that they're aged accounts, because they're brand new. So depending upon whether the accounts are any good or not, that will have an effect. So over the next couple of days, you're going to find the fact that those potentially, some of that information is going to change quite considerably. I mean, if we looked in the last month, actually, provider A, just to give an example, provider A 4 weeks ago, so there was no difference to that company whatsoever, and provider A were offering 242,000 and a score of 29. So as it's getting a bit older, that's been the cases of it.
I'll do the next one, Dan.
Okay, cool. So the next one,
conscious of time, that's all,
is MJ Wilson. I think I'm trying to do this without.
I know what you're trying to do, yeah. Well done, you didn't see that either.
Right, so
it's MJ Wilson.
Oh yeah, sorry, I've looked at the time, sorry.
Yeah, the MJ Wilson, there's the accounts, hold it there for a minute. Consolidated accounts, currency, sales revenue, 15, whether it's going up or down, tangible assets, net assets. Okay, a bit further. So accounts reference date, September. Account summary full. We got fixed assets, trade creditors, quite high. Liabilities, net worth. Okay. Okay. Right. Right, that one, hold that one there. Payment experiences summary. So 1 to 3 days over, 30 days overdue, balance within terms, balance overdue, etc., etc. Okay. What else? They've got mortgages. Judgments and charges. Satisfied mortgages and charges. And some of the history, filings, etc. New board members, blah, blah, blah. Okay. Anything else on there, Dan, you want to show us?
Just the directors, which I think is important.
Okay. All right. Let's stop share. Let's see if we can do a quick poll on that one.
Cool.
So poll on this one. Let's go down to the next one, which is this one here. Poll number 3. So launch the poll. So we have 3 questions. Is it low, medium, or high risk? Again, all completely anonymous. Nobody can see it. Low, medium, or high. And high jumps into the lead. 55% of people think it's high. 73% have voted. 59% high. 75 voted. 77, 80, 82. Okay, I'm going to end the poll now. So 62% reckon that's high risk. We've got 23% medium. And we've got 15% low risk. Okay, sharing the results. So there you go. Those are the results there. 15 for low, 23 for medium, and 62% for high. Okay, I'm going to stop sharing that. Dan, if you want to show us the results.
I think I hopefully did that better this time.
I think you did. And there we are.
So provider A, I haven't changed providers. So provider A is 0 and a 6 out of 100. B, 22,000 and 62 out of 100. 67,000 and 42. And then 0 with a risk score of 12.
So generally speaking, the risk index is suggesting that it's a higher risk.
Correct. Well, yeah,
Generally overall, it's a higher risk.
But this is where we've sort of looked at things, Chris, isn't it? And there is no right answer. It's not a test because
exactly, yeah.
Because dependent upon which provider you're using, depending on which information, depending on your appetite for risk.
And based on the previous questionnaire that we put out earlier, where we asked how many credit reference agencies you use, 44% of everybody said just the one. Yeah?
Which that could be, the right one for them.
Yeah, indeed.
If they never looked at the difference, then this is certainly a work.
Yeah, indeed. Yeah. Okay. Do you want to go to the next one then, the final one?
Yep. So let me try and make sure I do that quick. This is quite a quick one, to be fair.
Okay. Precision Proco Group.
Okay. So
it's a newbie.
Yeah. That's why no accounts, no nothing. Interested to see what you think to this. Based upon what we were saying before about new starts.
Yeah. New board member. Right, there's not much there at all, is there?
No. 1, 2.
3 directors.
More than that.
4 directors.
5
directors. 6, 7. Crikey.
7.
How many do you need?
Okay. Then stop sharing, yeah? Stop sharing.
Yeah. Okay, stop share. I will now give this is the final poll, the final test. Let's go to the final one here. This is credit risk challenge. There we are. So do you think this kind is low risk, medium risk, or high risk? And high risk jumps in the lead straight away. Good Lord. Yes, 87% of people so far. 83%, 81%. Low risk, 1 person put low risk. 82, we're up to 88% have voted. So I will end the poll. And that is, pretty significant. That's 80, I'm to share the results. 82% say high, a 16% say medium, and low 3%, or just 1 person came up with that one. Okay, I'm going to stop sharing. Okay, Dan, what's the scores on the doors? Literally the scores on the doors.
Can you see that? Yeah.
Yeah.
Okay, so provider A, 54,092 out of 100. These are all the same providers, by the way. Let me just accommodate that. So it's not like I've jumbled them up. B, £500, 49, £5,000, 56, and 00. I can give you the reasons why that is, if you'd like me to, really quickly.
Yes, please.
There's no accounts filed. So equally, that's got an effect on D. Provider A gives a bigger score. Is that me or Jane?
I think that's you, mate.
Let's get rid of them. Gone. Sorry about that. So there's been no accounts filed, but provider A gives bigger score purely because of the fact that they are part of a group. So it doesn't matter whether that's a good group or not. And there was no negatives. So there was no negative director associations. So they're erring on the side of giving them good.
Right.
There were more than 3 directors. Provider B gives no scores as no accounts, no nothing, which will affect the entire group as well. So actually, this is the top of a group where there are already, it's been brought in, even though there are other companies that are below the group as part of subsidiaries. And those subsidiaries are actually trading really, really well and have been trading for many, many years. What's then happened with particular providers is that because this has gone in at the top, a subsidiary will not get no bigger than the parent for some providers.
Right.
Now
Yeah.
the whole group is now on 0 maximum risk.
Right. Okay. Interesting. Yeah. Again, all very different. And everybody there thinking it was a high risk, whereas others, the number one thinks not. But yeah, okay.
Yeah. So even from looking in the last couple of days, I think that there are a number of companies out there that have got products and scorings that are trying to take into consideration the current circumstances. But in reality, information from credit reference agencies is based upon facts. So if someone's paying late and they're paying late because they're struggling with regards to to lockdown and that type of thing, we're not necessarily as credit reference agencies going to say, well, they're good credit because there's a reason they're paying late. We're going to say they're paying late. That's for an area of concern. I think the level of weighting on that information that is certainly taken away from the accounts is being given more weighting. But realistically, I haven't seen anything that's changed in the last 12 months in terms of the scoring wise.
Right. Okay.
So what I think we just need to do again, and we look at some of these sources. So you look to complement the data by getting information from a host of different sources. Like I said before, a credit reference agency, particularly if you're using 1, 2 or more, then you'll find that is a string to your bow, not the holy grail. I'm going to whip through these based upon time. My last screen, but just some of the things you can do. Again, I've been saying it all along, and I'm sure that most of you, if not all of you, do it. Maintain your dialogue. So speak to customers, speak to suppliers, find out how they're doing, what you can put in place to be able to complement your other data that you're getting through. I think that it's worth looking at social media. Don't necessarily think that it's always true, as well as other sources, companies' websites, but look for good as well as bad. So if, for example, you find that they've just merged or acquired a company, that actually can affect what you do with them. Be aware of the government support schemes that they could have available to them. They may not know themselves. I think that we've got to look in this basis that fraud is going through the roof. I know that another reference agency that we work with are really focusing on fraud at the minute. They're really trying to look at products that they can bring out to add to their portfolio in order to better focus on fraud. That's going to be a huge area, and making sure that you've got the things in place. Might be worth, if you're not already looking at open banking or customized scorecards, adding your own data in. And there are a few things out there, the impact score, the dual report and the H-score forecast, some of the things that are products out there that may be worth looking. So there's certainly some opportunities out there to complement your decision making. But equally, I think, as I've said before, it's about trying to bring everything together and try and make that decisioning with all the sources that you have available to you.
Okay. Great. Thanks, Dan. Can we have this presentation?
Yeah, of course. Yeah.
Yeah. If you want to ping it over to me, Dan, then that'd be great. Thanks very much, Dan. Really interesting stuff.
Sorry about the timing.
Sorry
about the timing. Sorry, it went over.
No. Really, don't worry about it. Don't worry about it. These things always overrun, as we know. You can you've got the details there, but you can stop sharing. If anybody wants to have Dan's email address, it's actually in the CC. On the email that I sent out to actually launch this session to everybody. What is the one USP Here we go. Here we go. What is the one USP that CoCredo has over the rest of CRA providers? That's a good question. And Jason, I'm gonna take Jason off this call now. What's the one USP, Dan? Do you think?
I think for us, we try to, taking away the other things in terms of the portal and the customer service. I think that it's trying to bring the data together. So we're not necessarily just working with D&B because we think that they're a good brand. Actually, we've interrogated the data to find out in some respects D&B aren't what our perception would be. So we actually interrogate the data on a blind tested basis, and then we work with those partners that have the most predictive basis. And taking Jason on this call, Credit Safe are one of those companies. So we work closely with Credit Safe, and we're incredibly proud to be so, because they have certainly, if not the best data out there, certainly one of them. So that's no, I've got no qualms about saying that. So I think it's about trying to bring all those sources together. And don't get me wrong, Credit Safe, D&B, Experian, Graydon, they're all trying to do that to a level as well. But I think we're quite open about that on the basis of our model.
Yeah, I've got a question here. That we've got all of these sorts of things. I'll be interested to sort of throw this question out to everybody. We've seen all the data that Dan provides, and there's stuff in there that you probably didn't know about, that people don't know about. Like, for example, the duty to report. To sort of demonstrate that organisations have to publish their accounts payable information if they're greater than a certain size. But what do you think? And this is a question to everybody, and just chip in if you've got any thoughts on this, or just stick it in the chat here. What data do you think? What additional data, I think, is probably what we're looking for here. What we probably need to ask. What additional data do you think you would need, or what more would you want to make better credit decisions? Yeah, so the data that you've already got in credit reference agencies, stuff like that. But what other data would you like as credit professionals? We've spoken a bit about the social media stuff, and we know that everything on social media is absolutely truthful, don't we? But is there anything that you think is missing that organisations could do? Is there anybody want to sort of chip in there, or stick it in chat and we'll capture it on chat? Might be a question to put out onto LinkedIn. Actually, I might do that actually, just to sort of see what people say, or do a does anyone question, because I've got a couple of other does anyone questions to raise for other organisations. So it'd be probably quite a good thing to send out an email to everybody on, because it's quite an interesting question. So I'll do that, and I'll see what the answer is, and I'll share it with them.
Chris, I would just say that an insolvency. I'd say that an insolvency practitioner once said to me about 20 years ago. He said, if the company has flagpoles, Ferraris, fish tanks, or fountains, then they're going to go bust. So that's what I'd like to know.
Yeah. Which of the directors has just got a brand new Ferrari? Yeah.
Exactly.
It's not the cost of the car that's going to kill you. It's getting the damn thing serviced, apparently. So okay, well, yeah. It's an interesting question. I think that's something. Has anybody got any other questions they want to ask on here while we're on? Okay, right. I'm going to run. I'm going to stop the recording now, but we'll carry on afterwards. So, Dan, brilliant. Thank you so much for your time. We'll carry on afterwards, because I've got a questionnaire, another poll that I want to run with everybody. Thanks very much for your time. As always, very insightful. This will be on YouTube. It is being recorded now. As I said, it is going to be on YouTube, and I'll post it on, or rather, Becky and the team at HQ will post it onto YouTube once I've had a look at it and make sure it's all okay. Apologies for a couple of times Dan's machine froze up there, but that's okay. That happens quite regularly, as we all know. We're getting very tolerant of that kind of thing these days. It's kind of, you just have to be. Next session next week is going to be all about accounts payable and accounts receivable. So we've got AR and AP on the calls next week. We've got two senior people, one from the AP community and one from the AR community, talking about best practice in their groups, plus a solution that solves the problem for both AR and AP. And that's a 2-hour special. That's next week at 11 o'clock on Thursday. Next week, 11 o'clock on Thursday, a 2-hour session on AP, AR, and joint solutions for both, which will be very interesting. So if you want to bitch and moan about AP, then you can contact us and you can join that call. And similarly, if you are an AP person, and I know a number of you are, you manage both, you can do the same. So we've got bugbears, discussions, what's annoying, etc. on the both coming up next week. So that should be quite a good and interesting session. So that's it. So I'll stop the recording now, but we'll carry on shortly afterwards. So thanks very much, everybody, and we'll catch you again next week.